Welcome to the deep dive. If you're an investor, you're always on the hunt for that one company that seems to defy economic gravity.
Mm-hmm.
Today, we're doing a deep dive into the philosophy built around that very search. Pat Dorsey's framework for finding durable competitive advantages, or as we all know them, economic moats.
That's really the heart of it, isn't it?
Yeah.
I mean, Pat Dorsey basically built Morningstar's entire equity research framework.
For a decade, right?
Yeah, and his whole contribution was to move past just asking what a company does well and to start asking why that success lasts. He wanted a systematic, objective way to figure that out.
Because, if you don't have that, basic economics tells you that huge profits, they should just disappear over time.
Precisely. If you're making extraordinary returns on your capital, competitors should just flood in, copy what you're doing, and those returns get driven down to, basically zero. They revert to the mean.
But they don't always.
They don't. And that's the puzzle. So our mission today is to pull out the objective characteristics you, as an investor, need to see, to find the structural reasons why some companies survive and even thrive in the face of all that competition.
And it's a different perspective. It's not the manager's viewpoint, like Porter's 5 Forces, which is all about how do I run my business.
Exactly. We're not managing the company. We're choosing it. So Dorsey's framework is all about what is durable, what is predictable. It helps us manage that uncertainty of trying to guess future cash flows.
So let's start right there with that core concept, the economic moat. Warren Buffett gave us the term, but Dorsey really defined it for the average investor.
He did.
What are the two sort of non-negotiable criteria?
Okay, so for competitive advantage to be something you'd actually pay up for, it has to be 1, structural, and 2, sustainable.
Structural. What does that mean in practice?
It means the advantage is just inherent to the business itself. It's in its DNA. Think about a major railroad. The legal hurdles, the sheer amount of infrastructure that's struck.
So it's literally built into the ground. It's not just, a fresh coat of paint.
Exactly. And that flows right into the second part. Sustainability. Because, a hot product or a viral marketing campaign can give you great returns today.
But it might be gone next year.
Right. If that advantage disappears in 3 years, it has no long-term investment value. Sustainability is why things like pipelines or certain utilities are so attractive. Their competitive advantage is predictable. You can look out 10, 20 years. It simplifies everything.
I think the most surprising part of Dorsey's work for me, and maybe the most counterintuitive, is how he treats management.
Yeah.
He's just so clear that a good manager, or even a team of talented people, that is not a moat.
It's the ultimate reality check, isn't it? You'd think, well, of course, a brilliant CEO is a huge advantage.
Yeah.
And they are, but they're also transient.
They leave.
CEO turnover is incredibly high, and Dorsey loves to use those classic, almost cynical Warren Buffett lines to make the point.
The one about a brilliant manager meeting a terrible business.
That's the one. When management with a reputation for brilliance meets a company with a reputation for bad economics, it's the reputation of the company that remains intact.
Ouch. It's a brutal reminder that the business itself matters more than the person running it.
It does. And Buffett's other line, good jockeys will do well on good horses, but not on broken-down nags. You're buying the horse, not the jockey. The economics of being an airline or a pharma company change very, very slowly. Managers come and go.
Okay, so if we're not betting on the jockey, we need a really clear way to identify the good horses. In the 5 Rules for Successful Stock Investing, Dorsey lays out 5 main ways companies build these moats.
Yes, and these are the core categories. Every investor needs to be able to spot them.
Okay.
So there's 1, product differentiation. Think branding like a Tiffany.
Real or perceived.
Right. Then 2, cost leadership, just being the cheapest for structural reasons. 3 is customer lock-in or high switching costs.
Okay.
4 is locking out competitors, which is often regulatory, like patents. And then number 5, the one everyone loves, is network effects.
Let's zoom in on cost leadership for a second. It sounds simple, just be cheaper, but the structural part is what people miss.
They absolutely do. Real cost leadership isn't about starting a price war. It's a scale or a location advantage that's almost impossible for someone else to replicate.
Like a railroad or a big distributor.
Exactly. Someone like Fastenal. They're just obsessed with efficiency, with distribution density. And here's the counterintuitive part. A true cost leader often runs on thinner margins than its competitors.
Which looks bad on the surface.
It looks bad to an unsophisticated investor. But what they're doing is sacrificing a bit of profit now to build massive scale
Yeah.
and just starve the competition out. Think of early Amazon.
Right. They ran on razor-thin margins for years to get that volume.
And that scale eventually becomes the moat. Now, on the flip side, Dorsey would argue that the strongest moat of all is the network effect.
Why is that one considered the gold standard? What makes it so powerful?
It's the compounding nature of it. For a real network effect, like Visa or a financial exchange, the service literally gets more valuable as more people join.
It creates a feedback loop.
A self-reinforcing loop. So a competitor doesn't just need a better product, they need to convince all of your users and your suppliers to switch at the same time. It's almost impossible.
What about history? I mean, MySpace had a gigantic network. AOL had a gigantic network. A technology shift came along and just wiped them out.
That is the critical risk. You're right. The moat protects you from a direct competitor, but it might not protect you from total disruption.
So what's the lesson?
The lesson for MySpace is that you can't get complacent. Take Apple's iPhone. Dorsey says the moat isn't the cool design, it's the App Store.
It's the network of developers.
It's the network. If all those developers suddenly found a better platform to reach customers, Apple's moat would start to erode, and fast.
That idea of lock-in brings us to that other powerful category you mentioned, high switching costs.
Yes, customer lock-in. This is where simple inertia becomes your best friend.
The classic example being enterprise software.
Right, like an Oracle database. You could, in theory, switch to something cheaper or faster.
Yeah.
But the time, the money, the retraining, the risk that something goes horribly wrong.
It's millions of dollars and thousands of hours.
So the cost to switch is just functionally insurmountable. We also see it in specialized data, like CoStar Group for commercial real estate.
The Bloomberg of that world, basically.
Basically, brokers cannot do their jobs without that data. And that gives CoStar incredible pricing power and retention rates of around 90%.
There's a danger there, isn't there, if you push your captive customers too hard?
They get angry. And angry customers will eventually fund a competitor just out of spite. Dorsey noted that CoStar's CEO was smart about this. He focused on long-run profit maximization, not just gouging people in the short term. You have to keep delivering value. So now we've sort of defined the quality of the advantage, the width of the moat.
Yeah.
But quality alone doesn't guarantee a great investment.
Right. Finding a wide moat is just step one. Now we have to talk about its value.
Exactly. This is where we need to assess what you called the long runway. The moat is only incredibly valuable if the business has lots of opportunity to reinvest its capital at high rates of return.
So you're separating the protection from the growth potential.
I am. You can have a great moat protecting a shrinking pond. That's not what we want.
Can you contrast the two types for us, a high-value versus a low-value moat?
Sure. So first you have the high-value long runway businesses. Think Visa and MasterCard. They have this huge secular tailwind, the whole world shifting from paper to plastic. Their wide moat lets them grow right into that massive market.
Or a company with low market share in a big, fragmented industry.
Right, like Fastenal. They're huge, but they still have a low single-digit share of their total market. Lots of room to run, and their cost advantages protect them while they do it.
And then on the other side, you have the strong moat, but a short runway.
These are your stability plays. Think McCormick spices. The moat is huge, but people aren't suddenly going to start eating twice as much paprika. The market doesn't grow much.
Same for Microsoft Windows in the PC market. It's mature.
It's mature. The moat provides incredible predictability. But Dorsey's warning is really clear on this. It's not worth paying a ton of money for because it doesn't allow the company to grow all that much. If they can't reinvest that capital profitably, they have to give it back to you.
Which brings it back to management's job. If you're running one of these short runway businesses, your number one job is just don't screw it up.
Preservation. You have to be laser focused.
Yeah.
And we see failures when management gets, off strategy. Walmart trying to be Target and sell high fashion, forgetting their moat was about low cost.
Or a company like Cintas, which has a great moat in uniform rentals.
Moving into totally unrelated things like fire safety. That's usually capital being lit on fire because they have no competitive edge there.
It's interesting you say that because Amazon seems like the perfect counterexample. Their focus is legendary.
It is. And their initial moat wasn't really about the tech. It was about a fanatical focus on customer trust. 20 years ago, people were scared to shop online.
Right, you worried they'd steal your credit card number.
And Amazon just built this baseline of trust. You know you'll get the right thing on time. That's why even today, data shows something like 3/4 of people don't even bother to price check. They just buy from Amazon. They reinforced a soft moat with just pure operational excellence.
Okay, so we've got the qualitative side down. We've found the good horse. We see a long runway. Now we need the proof, the quantitative validation from the financial statements.
This is where theory meets reality. The financials tell you if the company is actually defying gravity or not. And Dorsey gives us 4 steps here.
Let's run through them.
First, you assess historical profitability. Second, you investigate where those profits are coming from. Third, you estimate how long the advantage will last. We talked about that. And fourth, you look
What are the key numbers, the financial indicators that prove a moat exists?
you're looking for durable profits, not just a one-year pop. So you want to see a consistent return on equity, or ROE, of over 15%.
For how long?
I'd want to see it for 5, ideally 10 years. That 15% number is key because it suggests they're earning way more than their cost of capital. They're actually creating wealth. You'd also want to see net margins consistently above 15%.
And you mentioned a holy grail metric for value creation.
Yes. Free cash flow. This is the real cash the company's left over after paying all the bills and reinvesting what it needs to just maintain the business.
It's what they can use to pay you or to grow.
Exactly.
Yeah.
And ideally, we want to see that free cash flow number be more than 5% of their total revenue. That shows real financial strength.
But to get that full picture, you can't just look at one statement. You have to look at all 3 and understand how they connect.
That is such a critical point. The income statement is based on accrual accounting, which means revenue gets booked when a sale is made, not when the cash comes in.
So a company could look amazingly profitable,
But be on the verge of bankruptcy because none of their customers are actually paying them. The cash flow statement is the touchstone of reality. You have to check the balance sheet, the income statement, and the cash flow statement together to make sure those reported profits are turning into real cash.
And before we wrap up, let's just quickly hit those red flags, the junk you should filter out before you even begin.
Right. You screen out the tiny companies, the ones that don't file regular financials, but then look for 3 specific things. First, net income is going up, but cash flow is going down. Big red flag.
And then they're not collecting their bills.
Pretty much.
Oh.
Second, watch out for the serial chargers. These are companies with one-time or restructuring charges every single year. If it happens every year, it's not a one-time thing. It's a recurring cost they're trying to hide.
And the third one?
The serial acquirer. A company whose only growth comes from constantly buying other businesses. It often masks that the core business is actually struggling.
This has been a fantastic roadmap. It feels like we have a complete process now for looking at a business through this lens.
It really is a full process.
You identify the strong structural moat, that's the quality. You make sure it has a long runway for reinvestment, that's the growth. You confirm it with the numbers, that's the proof. And then finally, you have to apply disciplined valuation to figure out the price.
And that last step, valuation, is always the hardest. Because even with the widest moat in the world, trying to calculate a company's intrinsic value, it's subjective. It depends on your predictions,
Your assumptions about the future.
which can be wrong. And that is why the need for a margin of safety buying at a price well below what you think it's worth is still absolutely paramount.
So, does a wider, more predictable moat, like a Visa, let you use a slightly smaller margin of safety than something more fickle, like a brand-based moat?
That's precisely how most analysts think about it. The more predictable the future cash flows are, the more confident you can be in your valuation. The whole point of the moat framework is to increase that confidence and reduce the risk of your own faulty assumptions.
So, we've established that it's really the speed of industry change that matters now, maybe more than ever. Old, stable industries are being challenged by new kinds of moats.
Which brings us to a final thought for you, our listener, to take away. If you look at some of those older, stable industries that have always relied on simple cost advantages or, regulatory protection, think about regional utilities or maybe certain manufacturing supply chains.
The ones that seemed unassailable.
Exactly.
Yeah.
Which one of those today is most susceptible to being completely disrupted by a company that's building a new kind of moat? Maybe a hyper-efficient network effect or a totally new kind of switching cost that the market just doesn't see yet. How durable are those old moats, really? Something to think about.